The stock market, bear market, you were calling for, I think, another 20% decline a month ago. We're almost there, Gareth, but people are calling for even more downside. What's changed? Anything changed in the narrative since last we spoke about a month ago?
Well, I mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. You know, I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385, so 3,385 on the S&P 500.
Well, the Federal Reserve raised by 75 basis points only. I stress only. I mean, it's a pretty big jump, but only because there was a slight probability. I think an hour before 2 p.m. on Wednesday, there was an 18% chance of 100 basis points. That's what the Fed Watch tool was telling us. So it was more or less telegraphed. So yes, they are hawkish, but I'm wondering why the markets are still reacting as negatively even 2 days after the Fed meeting. I mean, markets know this.
Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage wise, this is an enormous hike, way more than Volcker back then. And it's going to have a major impact on the economy. And again, this is what scares me about things. Is like, you know, it's one thing to say, oh, you know, if we go into recession, the Fed can save the day by coming in and, you know, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market?
I want to come back to your comment on the yield. Yeah, this is scary. 3.7% is the latest reading I'm looking at on the 10-year. Let's just take a look at what happened this year. Since the beginning of the year, it's gone up at least 200 basis points. All right, at the beginning of, as of last year, exactly a year ago, it was only at 1.48%. Do you think that the 10-year would have gone up to current levels had the Fed not been as hawkish as we've seen? In other words, had the Fed done nothing, would the bond market still have performed as poorly given the outlook on the economy?
So my thinking is that the bond market would have pushed rates up. In fact, even before the Fed started raising rates, the bond market had pushed rates up. But I don't think that the bond market would have gone to this extent. I think the bond market, which is a smart market, it's known as the biggest market, it's the smartest market, they see that you want to let the economy digest these rate hikes. And I think that's the major issue here, is that the Fed is doing them one after the other, 75, 75, 75. and you're not giving time for it to cycle into the economy. So for all we know, in 3 months to 6 months, when all of these hit the economy, we could find ourselves in a nasty, nasty recession. And again, that's what I think the market's getting skittish about. You can see the dollar is skyrocketing again today. That's putting pressure on risk assets across the board. And again, there's this kind of, it makes me think that the Fed is trying to reestablish credibility, but it's almost like they're doing it in the wrong way, right? They're not doing this measured, methodical approach. They're just saying, you know what, we got to punish the market because you guys expected us to be lenient forever. Now we're going to really kick your butt and show you that we're not. And I think that's really dangerous.
Okay. Just on today in particular, was there any news coming out of the headlines that spooked the markets in particular? I mean, I know Putin escalated the war in Ukraine last week, and of course the hawkishness of the Federal Reserve and other central banks around the world, that's an ongoing issue. But what particularly happened today? We had a pretty big decline in risk assets.
So I think the key is this, and this isn't being talked about very much in the media, but it's really worth noting, is that the last 2 nights, Japan has intervened in their currency markets to prop up the yen. And what they're doing to prop it up is selling US bonds, right? They're dumping bonds on the open market. But when you sell bonds, what happens to interest rates? It pushes interest rates up even more. So not only do you have a Fed that's saying, hey, we're going to keep raising rates even after this last 75 basis point hike, we're upping our guidance by year end over 4%. But now you have other countries saying, hey, listen, our currencies are getting crushed. It's hurting us. We need to now prop these up. We're going to intervene and then actually add to kind of the pain that we're seeing on the interest rate front. So it is a wacky situation. And it reminds me of almost going back to 2008 where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here.
And you said that inflation is going to be sticky at 4 to 5%, which is, so I'm assuming that you're saying that the Federal Reserve's policies are going to be somewhat effective because we're still at far above 5%. The latest CPI came in hotter than expected at, 8.3%, but it's still much higher than your target of 5.
Yeah, and there's no doubt that, you've seen commodities already coming in dramatically. Look at oil today. Oil's in the mid 70s all of a sudden, or in the mid to high 70s. It was just a few months ago well above 100. So you are seeing inflationary pressures kind of ease a little bit, but what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%, and they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down, those will come down, but you have that wage issue that is still sticky.